Welcome to Talker Tickers, where today we're breaking down the Varonis Q4 earnings call. We're going to tackle a really interesting question. How does a company beat estimates but still see its stock get absolutely crushed?
All right, let's just jump right in because this is the big mystery we need to solve. Varonis puts out what looks like a totally solid quarter, and then boom, the very next day, the stock gets hammered. So what on earth did the market see that the headlines missed?
And here it is, laid out plain and simple. I mean, look at this. A clean beat on the top line. They came in more than $4.7 million ahead of what everyone was expecting. And on the bottom line, non-GAAP earnings per share more than doubled the estimate. And for that, the stock plummeted over 10%. That is just a brutal, brutal reaction.
So, to really understand that reaction, you've got to look past the headlines. You have to peel back the layers a bit. The real story isn't in what they just reported. It's hidden in the details and, more importantly, in what they signaled is coming next. Okay, first things first, let's give credit where it's due. The top-line revenue growth was a respectable 8.7% year over year. Now, if you look at that number in a vacuum, hey, that's pretty solid. But as we all know, the market never looks at just one number in a vacuum. And this is where the cracks really start to show. The market zeroed in on two big things here. First, a miss on a GAAP basis, which always gets investors asking, what's the real profitability here? But second, and this one's a big deal, was the major contraction in gross margins. It fell all the way from 84.4% a year ago down to 80%. That's a huge drop, and it signals some serious pressure on the business. But here's the real kicker, the thing that actually moved the stock. Investors were way, way more concerned with next year than they were with last quarter. The past was fine, whatever. It was the future that management painted with their guidance that was, pretty underwhelming. And that's what really set the negative tone. And this is the number that really mattered. Management guided full-year revenue to a range of $536 to $544 million. Now, you have to remember, for a high-growth, high-multiple software company like Varonis, the market is always looking for growth to accelerate. This guidance just didn't signal that sharp, V-shaped recovery the bulls were banking on. It felt like the road ahead was going to be a lot longer and flatter than what was priced into the stock. So you can boil it all down to four key worries. 1, how fast can this new cloud model really grow? 2, where are margins going to end up during this big pivot? 3, and this is a big one, management themselves flagged a $30 to $50 million hit to free cash flow this year. And that all adds up to, number 4, a whole lot of skepticism about whether they can execute in the short term. Now, every single one of those concerns, they all tie back to this one central theme: management's huge strategic pivot to an all SaaS model. This isn't just a quarterly thing. This is the absolute heart of the Varonis story right now. It's a complete transformation of the company. And you gotta love this quote from the CEO. He compared their new SaaS platform to a self-driving car and the old on-premise software to a bicycle. It's just a fantastic analogy. It perfectly highlights how big of a technological leap this is, and it shows why they believe this painful transition is absolutely critical for their future. And to be fair, they have made some serious headway. Just look at this. Their SaaS recurring revenue is now a whopping 86% of the total. I mean, the transition is basically done. For all intents and purposes, Varonis is a SaaS company now. And that brings us to the new reality. The game is totally changed. The market isn't giving them an A for effort on the transition anymore. Now it's a show-me story. The question has become, okay, you're a SaaS company, now prove it. Show us you can grow this thing faster and more profitably than the old business. Okay, so let's put it all together. After digging through the numbers, the strategy, the good and the bad, what should we expect from here? This is our take, our official thesis on Varonis. So, first, for next quarter, we think they'll probably hit their guidance. They tend to guide pretty conservatively. But we're not expecting some massive beat because these headwinds are very real. Because of that, we think the stock is going to be stuck in the mud for a bit, probably trading sideways in a range until the company can string together a few quarters of solid proof that the growth engine is really firing again. And that all leads us to a market perform rating. The long-term plan? It's the right one. But the near-term risks just keep us on the sidelines for now. All right, finally. What if you're listening to all of this and thinking, I actually see a diamond in the rough here. I think the market is getting this wrong. For the long-term believers, here's one speculative idea for how you might think about playing it. The core idea here is simple. You're betting that this whole SaaS pivot is going to be a huge success eventually. So the trade could be to buy call options that are pretty far out in time, say 12 to 18 months, and are just slightly out of the money. What this does is it gives you leveraged upside if the turnaround story works and the stock really takes off. But, and this is key, your maximum loss is strictly limited to whatever you paid for those options. The huge risk, of course, is that if the stock just goes nowhere or goes down, time decay will eat away at that premium, and you could easily lose your entire investment.
And as always, we have to say it, this is for informational purposes only. This is not financial advice.